All right, welcome to the Unrealist podcast today. If you wanted to learn about multifamily property, and especially within opportunity zones, today is your day. I have the best guests. But first, our unreal stat of the day, and it's that there are close to 9,000 opportunity zones across the country, and over $75 billion have been invested in these opportunity zones. So allow me to introduce you to our illustrious guest, Cory Older. Welcome to the show.
Thanks. Thanks for having me.
Dude, thanks for being here. So I know that you've done so Cory is the founder and president of River City Capital Partners. River City has over 1,000 units under construction right now. They've got over 1,500 units in their pipeline, and they own over 700 acres of land, all within the Austin, Texas MSA. Austin, one of my favorite places on earth. And I know you've had a range of really cool experiences in real estate, working in corporate under Gary Keller at Keller Williams, investing in rentals. Tell me more about what you do today with multifamily and opportunity zones, and how you got there.
I took probably kind of a winding road to where I'm at now. My background's originally accounting, and I was in the finance department at Keller Williams, and then had a bunch of other roles there. And I started in the spec home business and migrated to rental properties. Right now, we're very multifamily focused, also a lot of land development. I'm really trying to build a company. I mean, I think probably anyone that's started a company has this moment where they realize they just own a job, and you're like, gosh, I don't really own a company. I own a job. And so that's been a lot of my focus the last couple of years is, okay, let's actually build this company out. So it's a machine and it's not just dependent on the principles, that we really have a system and a way of executing our business model over and over again. So that's been a lot of my personal focus as far as deals go. That's been a lot of multifamily and land development, and kind of fell into the opportunity zone space. Being my accounting background, I gravitated towards it probably quickly too. But of our units, I think, roughly 80% of them are opportunity zone deals, and it's been a great program, and definitely been fortunate that we were in the right place at the right time. And so, I do a lot of my role within the company is on the financial and the capital side, and working with our opportunity zone partners and attorneys and everything in that way.
Okay, so the average person, we've got a lot of real estate professionals. We got a lot of prop tech people. My guess is that 3/4 of them are hearing this and being like, okay, I've heard of an opportunity zone. I don't know exactly what it is, why is it, how is it attractive, and why? Could you just break it down for us?
It's easiest. It's easiest to explain with an example. So, imagine that, Kyle, you bought some stock. You bought Amazon stock, years ago for $1 million, and today it's worth $2 million, and you decided to sell it. You would have $1 million capital gain. You bought it for $1 million, sold it for $2 million. If you just pay your taxes come, I guess, April 2024, and you're at the highest tax rate because you made $1 million, you know, about $230,000 in capital gains tax. So you'd net, what is that, $770,000. Alternatively, if you take that $1 million, not the full $2 million, but just your $1 million gain, and you invest it into a business or a real estate project, something that's active, not just buying a piece of land, but an active trade or business in a designated opportunity zones. And opportunity zones were designated, I think, in 2018 by, by each governor, and they had to meet certain census tract requirements. It had to be, I think, the lower quartile. I can't remember how they how they rated or how they decided what was the lower quartile. But if you invest that money in an active trader business in one of those opportunity zones, you get a couple benefits. The first one is that $230,000 of tax, you would still have to pay it, but you wouldn't have to pay it till April 2027. So you get, in our example, you get a 3-year deferral, which is
Okay.
nice. But the big thing is if you invest in a business and you hold that interest in that business for at least 10 years, when you sell, you don't have to pay any tax. So let's say that 1 million, you invested it in one of our real estate projects in an opportunity zone, and it grew to $3 million in total value over the course of 10 years. And, you could be making money along the way. It's not like you have to wait till 10 years to get a distribution. You're getting distributions along the way. And then at the end of the 10 years, we sell the project, and in total, you made 3 million. So 2 million, 1 million was a return of your investment, and 2 million was profit. That 2 million, because of the way real estate works, wouldn't be taxed at all. That'd be a completely tax-free event because it was in an opportunity zone. And I'm in the real estate space, and most of the opportunity zones are in real estate, but it could be a business too. It could just be, hey, I'm opening up a Subway shop. And we're investing $1 million in the business and capital and the equipment. It'd probably be a really fancy Subway for $1 million, but you could do it in any of that. It works really well with real estate. So that's why most of the projects are real estate and real estate development.
Got it. So the main, so this was a program. When you mentioned the lower sort of quartile, this is to redevelop areas that are not invested in as often, and spur investment in. Okay, yeah, go ahead.
Yeah, sorry, I didn't mean to interrupt you. Yeah, that's spot on. I mean, I think the spirit of the law was to encourage investment and create jobs in these areas, because that's where that active trader business, if they had drafted the legislation that said, hey, you can just go buy a piece of land, not actually develop it, that doesn't create any jobs. So the spirit of the law was about, creating jobs in the area. I hate to use the word improving an area because it's super subjective, right? Some of the neighbors to our projects think it's great and we're improving it, and some probably aren't so happy. So, but it does create a lot of jobs in the corridor, in the various corridors.
So that's a good segue. So you all you're going into these areas, you're creating jobs, you're building typically some piece of developing some piece of real estate in this opportunity zone. There are major tax benefits, which is part of why it's attractive sort of for the people that may be attractive for the people that live there. It's certainly attractive for the people that are investing in this and getting that tax deferral on the first piece, and then complete tax abatement. I don't know if abatement, or what do you call it? Like it eliminates tax for that. Okay, so I understand.
Yeah, I
that.
mean,
no, go ahead.
Yeah, I was just going to add, I mean, abatement's the right word. I mean, a lot of people compare opportunity zones to a 1031 exchange. A 1031 exchange, at the end of the day, is a deferral. Like you're deferring. And then, I mean, eventually you're going to pay taxes. Opportunity zones, I think, gained a lot of steam and a lot of investment, partially because of that it's a true tax abatement.
Yeah. Okay, amazing. I get it. So the Urban Institute says that most of these projects, you look at this, over $75 billion that have been invested in them, are multifamily or commercial real estate. It sounds like that's your focus. Can you tell me, more about your latest projects?
Yeah. It works really well with multifamily for various reasons. We have several opportunity zone projects at different stages right now. And the next one to deliver will be a 518 unit project. The first about 400 will deliver later this year, and it's in a growing corridor of Austin, Texas. Actually, it's right next to the new Oracle headquarters in Austin, and not too far away from what's now the Tesla headquarters. And so we kind of we hit the time right in that we've had a lot of employers grow
No
in that
kidding.
area. Now, I don't think they didn't locate because of opportunity zones, but we've that is a really booming area of Austin with a lot of transportation plans too. So that's been really exciting. And then we have another one in North Austin, similar story. We like being next to major employers. So that one is next to Samsung's campus on Palmer Lane, also in an opportunity zone. That one will be phased, but will eventually be over 1,000 multifamily units in that location.
So
We've
these are
partnered
rentals.
on
These are
these. These
apartments.
are all rental. These are all, yeah,
Hmm.
because of that 10-year hold with opportunity zones, it doesn't work well to have for sale products. So it does
Hmm.
somewhat force the developer to do, not, I wouldn't say it forces the developer to do rental properties as much as it, I think, has invited capital, and the land that's getting opportunity zone benefits, are all going to be almost entirely rental in nature,
Sure.
just because of that
Okay.
10-year hold timeline.
That makes sense to me. Um,
Yeah.
and you've done, if I remember correctly, some of your, like when you say mixed use, you've had like movie theaters and restaurants. I mean, it, is
Yeah.
that correct?
Well, that's it's a good question. So the project that I just talked about on Riverside is a funny story. It was originally planned to be a mixed use. And you're exactly right. We had a movie theater lease in hand, and I was going to have a movie theater and some office and some retail. And right before the pandemic started, we were really digging in and decided, gosh, this movie theater, it would be exciting, be kind of a great anchor tenant, but we worried about just the flexibility of the actual building. Because if you think about
Mm,
a movie theater, if a movie theater went out of business, it's really hard building to repurpose, right?
yeah. Yeah. Yeah.
It's
Yeah.
very unique in nature. And we were just looking at the lease and just going, man, we just feel like this is too risky. And we pulled out. And then shortly thereafter, pandemic happens. And that particular theater ended up filing bankruptcy, to my knowledge.
Bankruptcy.
And
Yeah.
so
Yeah.
we got really, really lucky. And during that time, we switched to pure multifamily, and then we ended up
Hmm.
partnering with one of the local housing authorities to make 50% of the property have some affordable unit components, which we were really happy about. It's something that the community needs. It allowed us to qualify for some further property tax exemptions, and so it was really a win-win. So a long way of
That's really cool.
saying no, I have not done a movie theater deal, and I don't know that I will.
Okay. Yeah, I mean,
Who
it's
knows?
funny as much as I love film, and you and I can geek out about movies for
Yeah.
sure. I think affordable housing has become this thing and I think it'll get worse. And we can talk about that in a moment too. But this idea that especially in places like Austin, right? I remember maybe 10 years ago. I mean, the prices for rent or purchase were so much below where they are today. I can't even imagine it being, kind of an affordable place to be unless
Yeah.
you're kind of a higher income person. So
It's I think it's our biggest problem as a city right now. I mean, some of the things that have made the city so great and have the feel and the culture that it has
yeah,
been due to some artists and the music scene, and not that's not necessarily a high paying job, and
right.
it can be really hard to make ends meet, obviously, if you're a musician. And so some of these affordable housing projects that are popping up, I think, they go to a bigger thing of keeping those people so they don't have to move. They're part of the identity of the city and what makes Austin so great. And so, yeah, we're proud to be at least contributing in that way.
Yeah.
And I'm kind of excited about affordability right now because for the first time ever, I'm seeing some capital raise their hand and saying, hey, we're interested in a feel good deal. Like, yeah, we need to make a decent
Huh.
return.
Hmm.
But if we need to give up a little bit of return and, um, and, deliver some affordable housing, we're interested in that because, and it's not, it's coming from multiple angles. It's almost like comparing a stock and a bond. Why do people invest in bonds? Well, it's a lower return, but it's more certainty. And I think there's some of
Yep.
that too. It's like, okay, we can provide affordable housing. Okay, we know the affordable housing is going to be occupied. There's such a high demand for that. So it gives our return, while lower, there's more certainty. And it's just kind of a win-win. And so we haven't done any projects like that yet where we kind of artificially held rents below what was required.
Hmm.
But I think it's happening. I think, and I don't think I'm hoping that we're not the only developer having
Sure.
conversations with capital partners like that, because I don't know, it's kind of cool to see. I mean, I think it's a trend that we've seen in a lot of other industries, from Tom Shoes or Warby Parker and all these other things, where
Yeah.
there's a feel good piece of it. So why can't that happen in real estate?
100%. No, so it's something actually we talk about a lot with our platform. And how do we, besides, so obviously, on real estate's focus on lower fees, transparency and commissions, often flat fees. And that to the home buyer or home seller, there's a direct benefit. But we're trying to figure out, is there a way to make it easier for that person to help another person, maybe whether they know them or not?
Yeah.
And we've looked at the buy one, give one model, the Warby Parkers and, Bombas of the world. We looked at a couple other models
Yeah.
too, but yeah, it's something it's definitely something we talk about a lot, and want to execute on.
Yeah. That's great.
So, okay. Would love to hear more about, everybody's talking about high interest rates, right?
Yeah.
And how that affect, and I guess I don't think a lot of people realize, not only does it affect, down to the consumer who's buying, say, the, $200,000 house, but to the developer like you've got to finance this deal, and it's still your bank debt is still being priced on the same, increase in rates. So we'd love to hear about how you've been able to survive and thrive in this higher interest rate environment.
Yeah. I could talk a lot about that. It's been really interesting. I would say it's been a very difficult 6 months in the development world. Before talking about interest rates, I think it's important to understand just what's happening in the debt markets as far as construction goes.
Okay,
It's
yeah, go for it.
become exceedingly difficult to get a loan, a construction loan. And when I dig on that with the various lenders that we're talked to, it's a lot about a lot of their outstanding loans prior to the interest rates being raising. They were expecting, a normal cycle of payoffs. Those haven't occurred, and so what's happened is a lot of their lending buckets are still full. They're waiting for payoffs from loans that they already made, and it's really restricted their ability to finance new deals. And
But
then on
wait, why
top of
haven't
that,
the
yeah,
market was screaming hot? So why didn't
yeah,
those deals already pay?
yeah. So when interest rates go up, it affects cap rates is the short answer. So I know we have a lot of different people probably listening. A cap rate is, you probably heard of a multiple in the stock market. It's the same. It's the same thing, but in real estate. So in Austin, Texas, a year ago, let's say multifamily was trading at a 4% cap rate, which basically means if you bought a building, say you bought $1 million building, all cash, no debt, after you paid all your expenses, both operating expenses, property tax, reasonable management fees, all of those things, you'd make 4%. You'd make $40,000 on your million without any debt. It went to, now let's say it's up, almost 100 basis points. I think it was below 4. It's probably like 3.5, and maybe now it's at 4.5 to 5. That's a huge discount in real estate. If you do the math, maybe that was, I'd have to figure it out. 800,000, a couple $100,000 discount
Yeah.
in our example to hit the same to hit, for that same yield to hit that type of cap rate. So it's a long way of saying multiples went down, right? The value of real estate moves when interest rates move. So everyone's talking about interest expense. It's like, yeah, the interest expense is not good when you're doing development, and that line item is a lot bigger thing, but that's the small part. Reducing the future value of your real estate by, 10, 20%, that takes a really hard hit. And so you had a lot of people that probably bought projects on in Austin, at a 3.5 cap, and all of a sudden their building's worth is trading at a 4.5 or 5. They're underwater. They're not going to sell anymore. They're like, okay, luckily rents have gone up, so they're hopefully still servicing their debt. But I think that change and just uncertainty, right? If you're a buyer of real estate and interest rates are going up, that cap rates are going up, and you're like, well, okay, I don't even want to buy it at a 4.5 or a 5 because shoot, this might be even higher. So it creates a lot of uncertainty in the market. Then you're not having payoffs, and then banks are like, well, we're not lending because our balance sheet's too big right now. And so that is made the debt market extremely difficult. And so yeah, going back to your original question, in order to thrive, we've had to get creative. We're lucky in that have a good relationship with the local housing authority, and we're able to do some creative structures that allowed our properties to save significantly in property tax by providing these affordable housing, and gave us some savings during construction. We have really good equity partners which were willing to increase their investment, basically taking a lower leverage loan. And all of those things mixed together has allowed us to proceed. But one of our debt brokers, JLL, which is one of the biggest debt brokers, they've said to us, a large percentage of their construction deals nationally have been shelved. I mean, they're on the sidelines. I think it's probably north of 70, maybe 80% are just waiting for the debt markets to open up. So long answer to your question, but from my view, that's what's going on.
Okay, that's helpful. So getting creative is really how
getting creative's been
around this.
Getting creative, being having flexible equity partners. We partner a lot with family offices, large family offices which I really like because they tend to be looking at the big picture and not maybe caught up in that. Yeah, they're going, hey, this is a 10-year opportunity zone deal. These are in great areas in a booming city, and we're going to have ups and downs during a 10-year period of time. So having patient capital, having creativity so that your yields, are still there and where they need to be, have been absolutely, key parts of the success of our success. And, we got a little lucky that they happen to be in opportunity zones. So it's like, okay, we've got this expiring program. By the way, opportunity zones right now expire at 12/31/2026. So we have, a tax abatement for our investors, some property tax savings, and, flexible capital. Take even one of those three things away, I don't know where we'd be, but combined, it's allowed us to continue.
What are some of the negatives? I know maybe you touched on one already, but what are some of the negatives of developing opportunity zones?
Yeah, so good question. I'd say a few things. One, it kind of forces your hand. Like you said, are you doing any for sale product? It's like, no, we have to do rental product. We've looked at deals where we're like, gosh, this would really make sense to have for some portion of for sale condos. Well, the way the opportunity zone laws and legislation's written, you have to hold for 10 years. So it pushes you away from selling, even if it maybe makes sense. So that's one of the big ones. And I think there's a lot of derivatives of that, or different things where you're like, hey, this totally makes sense. This is good for the area, and it's good for the development, but we're just handcuffed because the legislation says you can't do X, Y, or Z.
Mm-hmm.
We have a deal we were looking at where we're like, okay, let's, the land is bigger than we want. Let's buy it all, sell off the portion we don't want, and then keep what we want. Like it well intended, in the spirit of the law, creating construction jobs, and it makes it things like that are doable, but they're very difficult when you're in an opportunity zone. And then I also think you get into a place, it's worked well for us, but you're dependent on the timing of your investors. We have a lot of investors that sometimes like our deals, but they go, man, I love this. I just don't have a capital gain right now. So you're dependent on a
Okay.
lot of things. You're just like, okay, I got to hold this for
Yeah.
a long
Yeah.
time. I got to catch Kyle right when he sells his Amazon stock,
Yeah.
because,
Yeah.
if I catch him before then, you're like, well, I don't have a capital gain, even though the deal looks great. So,
Oh, that's interesting.
yeah,
Okay.
those are some of the challenges. And overall, I like to headline that opportunity zones. It's like a nudge. The benefits are great, but it's not so great that it makes doing a bad deal worth it. Like the deal's still got to be really, really good,
Sure.
and it's a nudge. It's gravy.
Okay. Okay, that makes sense to me. What about trends in multifamily development in general? And if you want to touch on opportunity zone trends as well, that's fine. But I know it's sort of a subset.
Yeah, I mean, I don't think there's any real specific opportunity zone trends that come to mind. The two that I think I'm most close to right now, one of which we already talked about, is at least in Austin, it feels like there's an affordable housing trend, which I love. I think that's really exciting. And we talked about it as far as just equity partners starting to look in that direction too, which I think is really, really good. The other one that is definitely, I think, nationally one of the hot topics is build to rent homes, or sometimes you call them single family for rents. And these are really rental home communities. And the interesting thing about them is they take a really wide range of shapes. So, if I say a multifamily apartment building, there's this narrow range of what that product looks like. The apartments are usually about 800 square feet, and you have a mix of
Mm.
1 bedrooms and 2 bedrooms. And yeah, you have the downtown and garden style, meaning some have elevators, some have stairs, but there's this really narrow range of how apartments tend to look. In the build to rent, it's a really wide range. You have at one end of the spectrum, you have developers that are basically just building a horizontal apartment complex. They have, 500 unit detached apartments, and that it's, for all intents and purposes, it's an apartment complex. It's just you don't share any walls, and maybe you have a driveway, but it's really an apartment complex. And then at the other end of the spectrum, you have really single family subdivisions where
Yeah.
the developer
Or they're
has
renting
chosen
out the
to
whole
rent
thing.
those homes.
Yeah.
Yeah, and they might be 2,500 square foot homes, and you would if you're driving through, you would assume that they're owned by different people, and that's just a normal subdivision, and then everything in between. So it's interesting right now. I think
So
it's
this is one of those areas that always it piques my interest because so in Chicago the trend is, and if you anybody is walking around downtown or sort of River North area of Chicago right now, you'll see all these skyscrapers going up. I mean, dozens. They're all over the place. West Loop, all the way to the lake, lots of high rises. What you find is that they're almost universally all rentals, right? And
mhm.
this, I feel like maybe about 5 years ago, and I can't remember I'd love to give the guy credit. There's an investor who kind of flipped the switch on this to say, wait a second, why are we like building this thing and then selling it all as condos? We should just hold it and then earn the income off of that over a long period of time. And so we've had even international companies come in to do this. Certainly large asset managers do this, and it makes me wonder though, what does that mean for, number one, home ownership in general?
Mhm.
Number two, for and I don't want to make it larger than it is, society, but like even for just this community. I mean, at a certain point, a lot of people grow out of an apartment, right? And if there's no
Yeah.
place to buy, where do you move? And it makes me wonder if this is like, and people, I know there's some conspiracy theories about this, but is this the end of home ownership for a lot of people? Because now they're just building you this small thing that you're going to rent, right? And then when
Yeah.
it's time for you to get out of that, where are you going to go? To the other place where you're going to rent? Like in home ownership is such a wealth building sort of exercise. It makes me concerned with that trend. I don't know what you've seen on your side, but
Yeah. So, man, there's so much in there I could attack. I'm just deciding where to fire first.
Bring it
um,
on. Bring it on.
yeah. Well, okay. First, let me talk about the condos in your example of the downtown, and then I want to get into, is homeownership going away, which I'd say, absolutely not. On the condos, okay, this is just my belief, but I'm sure if I researched, I could get some evidence to support it.
Go ahead. All right.
That's going to ebb and flow because of what we just talked about. Condos
The cap
are
rate.
not sold on a cap rate, right? Yeah, when interest rates go down, right, and cap rates get really, really low, and developers are comparing, should I build this as a condo tower or a multifamily tower? Especially if construction costs are high, multifamily is usually done with a lower quality. It's like, gosh, what makes sense here? Sometimes just the dollar and cents are pushing you towards one product or the other. The other thing is condo. It's very timing dependent. Much more so than multifamily. It's considered, I think by most a riskier asset because it's all about on the moment that you deliver, depending on how you've pre-saled, what's the world look like right then? If you're delivering apartments, okay, it's absorbed over time. The rental, there's a little bit more tolerance there. So I do think some of that is just going to ebb and flow with capital markets and debt markets. On your home ownership, look, there's always going to be the desire to have your own home and build it your own way and customize it the way you want it. If you look at these rental communities, it's like, okay, maybe you can paint the walls, but even planting your own garden is restricted
But
because
this
it's
is
at
my
the end of the
point.
day.
I'm
Yeah.
with you. But the desire, I'm not talking about the desire going away. I think the desire might be increasing. I think society in
Mm-hmm.
general might be getting wealthier. People are, things are better than they were 50 years ago for most people. So from an economic standpoint, so the desire is
Yeah.
there. But if you're competing up against a multi-billion-dollar private equity firm that's just built 200 units and they're going to rent them, are you going to be in a position is there going to be inventory for you to buy? And if it's there, is it going to be
Yeah.
priced out of your ability to buy it because there's not as much of it? It's just supply and demand, right?
Okay. I see your point there. I don't think it's going to go away. It's like, okay, here's, I think the best way of explaining it and my view on it. We have a big piece of land, hundreds of acres in South Austin that is going to be a big mixed use subdivision. It's going to have multifamily. It's going to have some built to rent homes on it. And it's going to have for some different sized for sale home products. The reason we're doing those different products is because it allows us to deliver the whole project faster. So if we were only doing homes, and you just look at the absorptions of how often people are buying homes, maybe it's a 10-year project, right? Or I don't know,
Okay.
I'm probably a 5-year project. If we offer something to it's almost like offering various different products to your customers, right? If we do multifamily and then we also have build to rent and we also have for sale home, we can serve 4 customers instead of just one, and our velocity goes a lot faster. So it's not like the homes that we are going to sell are going to be higher priced because we're doing build to rent also on the land, just because we're building as many homes as we could sell. Like I don't think that situation occurs. Now, when you fast forward, I get your point. Like, okay, fast forward 10 years, the project's totally built out.
10, 20 years,
And
right? Like
yeah,
what happens
like
if look at Austin?
have you restricted supply
Yeah,
for
exactly.
force? Yeah. Okay. I'll agree that you've restricted the supply in the long term, for homes. But my point is in the current moment, your supply exceeds demand. When you're developing the project, it's not like if you had a bigger demand for sale homes, then you would do that. And I'd also say it's really in suburban areas that you're seeing this, right? In central Austin, there's not enough acreage where you could do this at a big level. So you're still
Sure.
going to have a bunch of individual homeowners. So yeah, I get your point. I don't think we're going to, I don't think it's a fad. I think it's going to stick around
Okay.
here. I get the desire. You hit it. Like, I think there's a lot of people that either are moving to a city for a short period of time, or whatever, their finances are such that they can't qualify for a loan, they can't buy a home, but they want a backyard and they have kids and they want,
Yeah, no, I actually
rental homes
understand
make sense.
the use case for a
Yeah.
rental home completely makes sense to me. And I'm not trying to say we don't need them. I just get concerned. And again, like on our platform, we've certainly done rentals in the past. We'll do rentals in the future. So I'm not biased by the fact that we specialize only in buy sell. But I always like look at what's happening on a macro scale and wonder, like, what does this mean? Like, look, we fast forward 20 years, right? Like, is it going to be this exotic thing to own a home that only like very wealthy people have, because everything else is just turned into rentals? And I
Yeah. I
wonder.
mean, it seems like the whole world is turning into a subscription, right? Like, it's
That's
just
what,
whatever
yeah.
you do, whatever you're doing. I mean, eventually you can see it very close that it's going to happen with transportation. I mean, I think I was listening to something with the Lyft CEO. It's like, okay, this is going to be a subscription eventually, where you've got access to scooters and
Yeah.
cars and all of these different modes of transportation. And so I agree with you. There's a trend towards just subscription or rent, and rather than ownership. But I
Well,
mean,
and there's one
the
part
other
of
thing on
that
this
says,
is,
well, I was going to say, so there's a piece of that says, wait, that's what the consumer, like, especially you talk to, let's say millennials and Zs, they're like more used to a subscription. Like, why would I own it? I can just stream it. Like, okay, fine. And then
yeah,
it sounds like it's a demand issue. Like, they don't want, but if you start to dig in and that person has a kid, that person gets a new job, and at some point they say, wait a second, I actually would, I prefer to be getting the equity, especially when we start talking about the monthly cost being almost at par or close to it, between owning
yeah.
and renting. When it gets there, you start to say, I might rather just build the wealth than give it to the landlord or
Yeah.
the asset manager. Right?
Yeah. I mean, but I also wonder, with these build to rent communities, are their tenants people that would have otherwise lived in an apartment, or they would have bought, or they've just lived in a rental property that was, not owned by a company, but by an individual? So I don't know. Is the point being, is this movement creating more renters, like you're saying?
Mm-hmm.
Or
Mm-hmm.
is it just giving the person that owns a
The
home
natural,
that would have rented
yeah.
them out, now they have competition? Now they can go to a company, now I can go to a company and I can get amenities, and I'm not like negotiating my lease with, some guy that's never rented a home before. Are we just
Yes.
professionalizing rents
Okay,
for
that is
rental?
for sure happening, right? And I think that's
Yeah.
not only single family homes, but I don't know if you've like paid attention to the storage, public storage, like the, what do you call it, storage space, right? Like
Yeah. I mean,
that
I've
used to
watched it a
be,
little bit.
okay, so that was like a mom and pop thing, right?
Yeah.
And now there are a couple. I know, like I've got a few friends that are in private equity that were like, we looked at what was happening with the numbers of like what I'm forgetting the term, but like storage units, and they've just
Yeah.
basically
Self storage.
industrialized storage, self storage. Yeah, they've industrialized
Yeah.
self storage. They come in, they buy out the mom and pop for one multiple, and then they come in, they put in real software, they put in real controls, they commercialize it, right? And
Yeah.
then 5 years later, it's worth far more, right? And so I think you're seeing the same thing in single family rentals.
Yeah. And where else you're seeing that is RV parks. Big money is
Yes.
digging into that. And so, yeah, it's funny on the self storage. We poked our head into self storage a little bit, and depending on what market you were in, it got way oversupplied because of that. So I don't know. It's going to be
Okay.
interesting.
Interesting. Okay.
Do we end up with the same thing on homes, where we have way too many rental homes? Time will
Okay.
tell.
That would be good devil's. Okay, that's good devil's advocate. I'll buy you on that one. Okay. All right. So I'm gonna recap. So you all have been heavy in the opportunity zone space, multifamily space. It sounds like there are major tax benefits, and that's one of the things that really gets people into it. But that's really just the gravy. They still have to be, deals that are worthwhile on their own. Um,
Absolutely.
Trends we see are towards affordable housing, which I think is great. And you and I mostly agree that single family rentals at a commercial scale could be a problem. Maybe not
I don't know if
our
I
problem.
put it that way.
All right, damn it. All right, well, we agree it's an issue that needs to be discussed further.
Okay. Agreed.
Okay. And then yeah, man, it's been great having you on the show. This is my favorite time when we do the sneaker check. Are you ready?
Yeah. I'm ready. You want to see him?
No, I'm gonna go first.
Okay, let's see him.
I think I had these on once before. I'm on Common Projects today. You see these?
Oh, nice. Nice.
They're kind
I
of
like
chill.
this.
They match everything. They're super comfortable. Yeah.
I got to see what mine are called. You'll know. Just the classic, I don't know, the three shoe hole. Just like your normal.
Oh, like a chukka.
Your normal
like
shoe.
Boot. Yeah.
There you go.
It's a
kind of
brown
goes with
chukka.
everything.
You know what? All right, you surprised me. I really thought I didn't know what you were going to roll with. That is a perfectly business casual, appropriate shoe.
I wish I would have been wearing. I've got these new Vans. I've been rolling those a lot to work.
Oh, see.
So you just caught me on an off day. I didn't know about the sneaker check.
No, I remember we had a discussion once about square-toed dress shoes that you were
rocking. Yeah.
I'd have an intervention with you that it was done.
Yeah, it was a coaching session where you told me I couldn't do them. Like, you can't wear those anymore.
Okay, I thought you were gonna, maybe break those out today, but it's cool. No, I got you on the chuckers. Those are nice.
Thank you.
All right, man. Thank you so much for coming on the show. Anything you want to plug in? Website development you're working on? Anything our listeners should look out for?
Yeah, I mean, nothing really. If you want to learn more about what we're doing, rivercityus.com is our website. You can see our projects and reach us. And yeah, thanks for having me. This was fun.
My pleasure, man. Thanks for being on. Talk to you soon.